when silver collapsed 26% in a single day, something unprecedented happened. Dealers stopped selling. Prices at coin shops remained above $100 per ounce. Even as spot markets showed 79. The paper price said one thing, but physical reality told a different story entirely. What you're witnessing isn't just volatility. It's a fracture in the market itself. And the implications? Welcome to Silver Radar. If you've spent decades watching markets, building businesses, understanding how economic systems truly function, then you already know that what we're about to discuss isn't theory. It's reality unfolding in real time. Before we proceed with this analysis, I'd like to ask you something. Could you take just a moment, move your cursor down, and subscribe to this channel? We're building a community of serious thinkers here. People who understand that economic literacy isn't optional anymore. And while you're there, leave a comment telling us where in the world you're watching from. Are you in the United States, Europe, Asia, South America? Your perspective matters, because what's happening with silver is happening everywhere simultaneously. Now, let's examine exactly what's taking place and why it demands your immediate attention. On January 29th, silver closed at $115 per ounce. 24 hours later, $85. By the following Monday, $79. A 26% collapse in a single trading session. For those who track commodities professionally, this wasn't mere volatility. This was a structural event, the kind that reveals fractures in market architecture that most participants never see until it's too late. But here's where the story becomes interesting. While silver was experiencing this dramatic sell-off, gold declined as well. The difference? Gold's correction was measured, controlled. The percentage decline was modest by comparison. Silver, however, moved with the violence typically reserved for speculative assets in crisis. This divergence demands explanation. The gold-silver ratio, a metric that sophisticated investors have tracked for centuries, tells part of the story. Before this event, the ratio had compressed below 50-1. This meant that 50 ounces of silver could purchase 1 ounce of gold. Historically, when this ratio tightens, it signals that silver is being revalued relative to gold, that market participants are recognizing something fundamental about supply and demand dynamics. Then came the crash. Within days, that ratio expanded to 54.89-1. Silver had lost relative value against gold rapidly and dramatically. On the surface, this appears to be a simple correction. Markets overextend, then they revert. Standard behavior. Except something else was happening simultaneously. Reports began emerging from across the United States. Coin shop owners, the front line of physical precious metals distribution, were behaving strangely. Some stopped selling silver entirely. Others kept their doors open, but maintained premium prices that seemed disconnected from the spot market collapse. Think about that for a moment. Spot silver trades at $79, yet a dealer charges $105 for a 1 ounce round. That's not a premium. That's a 33% markup. In normal market conditions, premiums on generic silver rounds run between 3 and 8% over spot. This wasn't normal. What you're observing here is something that economists call price discovery failure. The mechanism that's supposed to connect supply with demand, buyer with seller, has broken down. The paper market, where silver trades electronically in massive volume, was saying one thing. The physical market, where actual metal changes hands, was saying something completely different. And this is where most analysis stops. Financial media will call this a liquidity event, or a technical correction. They'll point to margin calls, leverage positions being unwound, algorithmic trading systems amplifying moves. All of that is true. All of that happened. But it doesn't explain why dealers wouldn't sell. If you own inventory, and the market price drops 26%, the rational response is to liquidate that inventory quickly, take the loss, preserve capital, redeploy into better opportunities. That's basic business management. Unless you believe that the paper price is wrong, unless you understand that replacing that inventory at current wholesale prices is impossible, unless you recognize that what you're holding has become more valuable than what the screen is telling you, this is the anomaly that requires investigation. When markets function properly, arbitrage opportunities disappear within seconds. If spot silver is trading at $79 and dealers can sell physical rounds for $105, then wholesalers and refiners should flood the market with supply. The $26 gap should collapse immediately. It didn't, which means one of two things is true. Either there's a massive inefficiency in the distribution system, a logistics breakdown preventing metal from reaching retail channels, or there isn't enough metal available at any price that makes sense for dealers to restock. Both possibilities are concerning. The first suggests systemic fragility in commodity supply chains. The second suggests something far more serious, that physical silver supply is constrained in ways that paper markets haven't priced in yet. And here's what makes this particularly relevant right now. This isn't happening in isolation. Industrial demand for silver has reached historic levels. Solar panel manufacturing alone consumes more silver annually than total mine production in some years. Electronics, defense applications, medical technology all require silver in quantities that continue growing. Meanwhile, investment demand hasn't disappeared. It's shifted. Institutional players, sovereign wealth funds, family offices managing generational wealth, they're not trading silver on screens. They're taking delivery, physical delivery. When paper prices collapsed last week, these participants didn't panic. They accumulated. And that divergence between what the charts showed and what informed capital actually did, that's the signal demanding attention. Because what happens when the gap between paper pricing and physical reality becomes too wide to ignore? The reports came in quietly at first. A comment here, an observation there. Individual experiences that seemed anecdotal until the pattern became undeniable. Across multiple states, in cities large and small, the same phenomenon was occurring. Coin shop owners were making decisions that defied conventional business logic. They were turning away customers during what should have been their busiest week in months. They were refusing to sell inventory at prices that still guaranteed substantial profit margins. Some simply closed their doors. Others posted signs explaining that silver was temporarily unavailable. And the ones who remained open? They were charging premiums that bore no relationship to the spot market carnage unfolding on trading screens. Consider what this means from a pure business perspective. A coin shop operates on thin margins. Their entire model depends on volume. Buy wholesale, sell retail, capture the spread. When spot prices drop dramatically, inventory that was purchased at higher levels becomes a liability. The prudent move is to liquidate quickly, take the loss, and rebuild inventory at lower cost. Every business school teaches this principle. Every experienced dealer knows this reality, yet they weren't doing it. They were holding inventory, maintaining premium structures, and in many cases, simply refusing to transact. This isn't panic. This is strategic positioning. These are operators who understand their market intimately, making calculated decisions based on information that screens and charts cannot convey. The question becomes unavoidable. What do they know that the broader market doesn't? The answer lies in understanding the difference between paper markets and physical markets. When most people check silver prices online, they're looking at spot prices. These are determined by trading activity on exchanges where contracts representing silver change hands electronically. Hundreds of millions of ounces trade daily in these markets. The volume is staggering. The liquidity appears infinite. But here's the critical detail that most miss. The overwhelming majority of these contracts never result in physical delivery. They're settled in cash. They're closed out before expiration. They exist purely as financial instruments, divorced from the actual metal they theoretically represent. Physical silver operates in an entirely different ecosystem. Refiners produce it. Mints strike it into coins and bars. Wholesalers distribute it. Dealers sell it to end users. Each step in this chain has capacity constraints. Refining capacity cannot be scaled overnight. Minting capacity is limited by machinery and labor. Distribution networks have geographic and logistical boundaries. And at the retail level, dealers maintain inventory based on their ability to source replacement metal at predictable costs. When this chain functions smoothly, premiums remain stable and predictable. When it doesn't, the system reveals its fragility. What happened during the price collapse was a stress test of this physical infrastructure. Spot prices plummeted, but the physical supply chain didn't respond with increased availability. Instead, it constricted. Wholesalers raised their prices to dealers. Even as spot prices fell, mints extended their delivery timelines. Refiners prioritized contracts with large institutional buyers over smaller distributors. The metal that was theoretically abundant according to paper markets became scarce in physical form. And dealers, who live at the intersection of these two realities, made the rational choice. They protected their inventory because they understood that replacing it would be difficult, expensive, or potentially impossible at prevailing wholesale costs. This creates a fascinating economic paradox. In a functioning market, lower prices should stimulate demand and bring forward supply. Buyers who are waiting for better entry points should flood in. Sellers holding inventory should release it to capture liquidity. The market should clear at a new equilibrium. But that's not what occurred. Lower paper prices didn't produce more physical availability, they produced less. And buyers who attempted to take advantage of the dip found themselves unable to transact at anything close to the spot prices being quoted. The market wasn't clearing, it was freezing. Now layer in the demand side of this equation. Industrial users of silver don't stop manufacturing because spot prices drop. A solar panel company doesn't halt production lines because silver got cheaper. If anything, they accelerate procurement. They lock in supply at favorable prices. They build strategic inventory. Electronics manufacturers, defense contractors, medical device companies, they all operate on the same principle. Secure critical inputs when pricing is advantageous. This industrial demand is constant, inflexible, and growing. Solar installation targets announced by governments worldwide require silver in quantities that strain annual mine production. The electrification of everything, from vehicles to infrastructure, demands silver in applications that didn't exist a decade ago. Then there's investment demand, not the speculative trading that dominates headlines, the institutional accumulation that happens quietly, systematically, through channels most retail investors never see. Wealth funds managing billions don't buy silver from coin shops. They arrange delivery directly from refiners. They negotiate contracts months in advance. They take possession of physical metal and store it in allocated vaults. When paper prices collapsed, these buyers didn't panic. They increased their orders. They viewed the dislocation as opportunity, not risk. And because they operate at scale, they command priority in the supply chain. The metal flows to them first. What's left for the retail market is whatever capacity remains after industrial demand is satisfied and institutional orders are filled. During normal times, this works adequately. Premiums stay reasonable. Availability remains consistent. But during periods of stress, when paper markets disconnect from physical reality, the retail buyer discovers they're at the back of the line. The coin shop owner who refuses to sell at spot plus 3% isn't being greedy. He's being realistic. He knows what it will cost to replace that inventory, if he can replace it at all. He understands that the screen price and the real price have diverged, and he's making business decisions accordingly. This is the breakdown that matters. Not the volatility, not the percentage moves. The structural separation between what paper markets indicate and what physical markets actually deliver. Because when this gap widens far enough, when enough participants recognize the disconnect, confidence in paper pricing begins to erode. And once that confidence cracks, the repricing that follows doesn't happen gradually. It happens all at once. There's a reason silver moves differently than other commodities. Copper doesn't behave this way. Aluminum doesn't experience these dislocations. Even gold, silver's monetary cousin, maintains more orderly price action during periods of stress. The difference lies in silver's dual nature. It exists simultaneously as an industrial input and as monetary insurance. This creates demand patterns that intersect in ways no other commodity experiences. And right now, both demand streams are intensifying at precisely the same moment. Understanding why requires stepping back from price charts and examining the broader monetary architecture within which all assets, all currencies, all stores of value currently operate. Central banks globally have engaged in monetary expansion on a scale unprecedented in peacetime history. The balance sheets that were considered dangerously large a decade ago now appear quaint. Federal Reserve assets, European Central Bank holdings, Bank of Japan positions. The numbers have grown so massive they've lost meaning to most observers. Trillions become abstract, but the consequences are concrete. Every unit of currency created dilutes the purchasing power of every existing unit. This isn't theoretical, it's mathematical. And while official inflation statistics suggest the problem is manageable, contained, transitory, the lived experience of businesses and individuals tells a different story. Input costs have risen, wage pressures have intensified, asset prices have inflated across nearly every category. The currency itself, the measuring stick by which everything else is valued, has become unstable. This matters for silver because silver has a 4,000-year history as money, not as a medium of exchange in the modern sense, but as a store of value, a form of wealth that cannot be printed, cannot be inflated, cannot be decreed into existence by policymakers. When confidence in fiat currency systems begins to waver, even slightly, capital flows toward assets with these characteristics. Gold receives most of the attention in this dynamic. It's the traditional monetary metal, the reserve asset, the central bank holding, but silver possesses advantages that gold cannot match. It's accessible at lower price points, it's available in smaller denominations, and it carries industrial utility that provides fundamental demand support independent of monetary considerations. This combination makes silver uniquely positioned during periods of monetary system stress. History provides the roadmap. The 1970s saw similar dynamics: monetary expansion, currency devaluation, rising inflation expectations, and a systematic repricing of precious metals that took silver from $1.50 per ounce to $50. The move wasn't linear. It wasn't predictable in timing, but the underlying cause was clear. The currency system was under pressure, and capital sought alternatives. The 2008 financial crisis triggered a different but related pattern. As central banks responded with unprecedented intervention, silver moved from $9 to $48 over the following 3 years. Again, the path was volatile, the corrections were severe, But the direction reflected a loss of confidence in the stability of fiat monetary arrangements. What's happening now contains elements of both previous episodes, with additional complexities that didn't exist before. Sovereign debt levels have reached points where traditional solutions appear inadequate. The mathematics of compounding interest on multi-trillion-dollar obligations becomes problematic when growth rates stagnate and demographic trends turn unfavorable. Politicians promise fiscal responsibility while delivering continued expansion. Central bankers speak of normalization while maintaining policies that distort every price signal in the economy. The gap between rhetoric and reality widens, and market participants, the ones managing serious capital, recognize the contradiction. They're not panicking. They're not predicting immediate collapse. They're simply adjusting their positioning to reflect increased probability of monetary instability over time, horizons that matter for wealth preservation. This positioning shows up in data that doesn't make headlines. Exchange-traded funds backed by physical silver have seen consistent inflows despite price volatility. Sovereign wealth funds have increased precious metals allocations in portfolios traditionally dominated by government bonds and equities. Family offices managing generational wealth have raised hard asset targets. These aren't retail speculators chasing momentum. These are institutions with 100-year time horizons making strategic shifts in response to changing monetary conditions. They're not trying to time the market. They're buying insurance. And the premium they're willing to pay for that insurance, measured in the prices they'll accept for physical metal, keeps rising regardless of what spot markets indicate. The geopolitical dimension adds another layer of urgency. De-dollarization isn't a conspiracy theory. It's official policy for major economies seeking to reduce dependence on dollar-denominated trade settlement. Alternative payment systems are being constructed. Bilateral currency arrangements are being negotiated. Central banks in countries representing half the world's population are actively diversifying away from dollar reserves. This doesn't mean the dollar's demise is imminent. Reserve currency transitions take decades, but the direction is clear, and the implications for dollar purchasing power are significant. As international demand for dollars decreases, domestic monetary expansion must be absorbed by a smaller base. The inflationary pressure that was previously exported globally becomes concentrated domestically. Silver responds to these macro forces because it sits at the intersection of multiple trends converging simultaneously. Industrial demand from the energy transition, investment demand from monetary concerns, supply constraints from decades of underinvestment in mining, geopolitical tensions affecting trade flows, currency instability creating flight to tangible assets. Each factor alone would support higher prices over time. Combined, they create conditions where violent price moves in either direction become more likely. The volatility isn't noise, it's information. It's the market attempting to find equilibrium between competing forces that all point toward structural scarcity. Consider what institutional players see when they analyze current conditions. They see real interest rates that remain negative when properly adjusted for actual inflation. They see fiscal trajectories that require continued monetary accommodation regardless of stated policy intentions. They see commodity supply chains that have been optimized for efficiency at the expense of resilience. They see currency regimes built on confidence that's increasingly tested by policy contradictions. And they see an asset, silver, that offers protection against multiple failure modes simultaneously. It doesn't require catastrophe. It simply requires continuation of existing trends. The derivative markets tell their own story. Commercial hedgers, the miners and industrial users who actually produce and consume silver, have reduced their short positions substantially. This typically happens when they expect prices to rise, or when they're unable to secure physical supply at prices that make hedging economical. Speculative positioning has become more volatile, but the smart money, the participants with actual exposure to physical markets, is positioned for higher prices, not because they're bullish, because they're realistic about supply availability relative to demand requirements. What does this mean for the current market structure? It means the paper price and the physical price are measuring different things. Paper markets measure sentiment, leverage, short-term trading flows. Physical markets measure actual supply and demand for metal that must be refined, transported, and delivered. During calm periods, these two pricing mechanisms stay aligned. During stress, they diverge, and the wider the divergence, the more unstable the entire pricing architecture becomes. Eventually, something forces reconciliation. Either paper prices rise to meet physical reality, or the physical markets decouple entirely and trade at premiums so large that paper markets become irrelevant. The monetary system isn't collapsing tomorrow, but it's under pressure that's unprecedented in the post-war era. And silver, because of its unique characteristics, is responding in ways that reflect that pressure. The question isn't whether silver prices will be higher next week or next month. The question is whether current prices, even after recent volatility, adequately reflect the fundamental imbalances building in monetary and commodity systems. The evidence suggests they don't. And the market participants with the most at stake, the ones operating in physical markets with real capital, are voting with their allocation decisions. They're buying, they're holding. And they're not particularly concerned about short-term price fluctuations because they understand what the volatility actually means. The conventional wisdom says, wait for lower prices, buy the dip, exercise patience, let the market come to you. This advice works beautifully in liquid markets with transparent pricing and reliable supply. It fails catastrophically when market structure itself is breaking down. And what we've witnessed over the past 2 weeks isn't normal price discovery. It's a preview of what happens when the mechanisms connecting buyers with sellers begin to fracture under stress. The strategic question facing anyone managing capital right now isn't whether silver will revisit $79. The question is whether silver will be available at any price when you actually decide you want it. Think through the practical reality of acquisition during the recent dip. Spot prices showed $79, exceptional buying opportunity by any historical measure. But could you actually transact at that price? The answer for most buyers was no. Coin shops weren't selling. Online dealers maintained premiums of 20 to 35% over spot. Delivery times extended from days to weeks. Minimum order quantities increased. Payment methods became restricted. The theoretical opportunity that appeared on screens never materialized in actual transactions. And here's what makes this significant from a strategic standpoint. This breakdown occurred during a brief 2-day window of stress. Imagine what happens during sustained pressure. Imagine what happens when millions of market participants simultaneously decide they want physical exposure. The premium structure itself contains information that most analysts ignore. When a dealer charges $105 for an ounce of silver while spot trades at $79, that $26 gap isn't arbitrary. It represents the dealer's assessment of replacement cost, delivery risk, and future availability. The dealer has relationships with wholesalers. He knows lead times. He understands refinery capacity constraints. He sees order flow from institutional buyers. And based on that information, he's making a business decision about what price makes sense for him to part with inventory. Dismissing this as price gouging misses the point entirely. This is market intelligence. This is someone with skin in the game telling you what physical silver actually costs in the real economy, not the paper economy. Now consider the decision framework from a capital allocation perspective. Every asset class faces risk. Equities can decline. Bonds can default. Real estate can become illiquid. Cash loses purchasing power. The goal isn't to eliminate risk. The goal is to understand what risks you're taking and ensure you're being compensated appropriately for those risks. Silver carries risks that need acknowledgement. Industrial demand could weaken in recession. Mining supply could increase if prices rise substantially. Government policy could shift in ways that affect precious metals, ownership, or taxation. These are real considerations. But they need to be weighed against the other side of the equation. What's the risk of not holding silver? What happens to purchasing power if currency devaluation accelerates? What happens to portfolio values if monetary policy errors trigger instability? What happens if supply chains for physical commodities remain stressed for extended periods? The asymmetry becomes apparent when you frame it properly. Downside scenario for silver, prices decline to $60, $50, even $40 in a severe deflationary collapse. Portfolio allocation of 5 to 10% in silver experiences drawdown, painful but manageable. Now consider upside scenarios. Silver reprices to match industrial demand at sustained higher levels, $150 to $200, or monetary concerns intensify and silver experiences a monetary premium similar to previous decades, $300 to $500. Or supply constraints prove more severe than currently understood, and both industrial and monetary premiums apply simultaneously. The mathematical profile of these outcomes is asymmetric. The potential downside is limited by production costs and industrial demand floors. The potential upside is multiples of current pricing. This is why sophisticated capital allocators view silver as insurance rather than speculation. Insurance costs money. You pay premiums, hoping you never need the coverage, but the cost of not having insurance when you need it can be catastrophic. Silver functions the same way in portfolio context. It costs something to hold. Storage fees, opportunity cost of capital not deployed elsewhere, premium over spot price. But what it provides is protection against specific failure modes that other assets cannot address. Currency failure, supply chain breakdown, banking system stress, geopolitical disruption. These aren't everyday occurrences, but when they happen, the assets that protect against them become invaluable, often unobtainable at any reasonable price. The business community faces additional considerations beyond portfolio diversification. Companies with exposure to silver in their supply chains need to think about procurement strategy differently now. Waiting for lower prices might mean accepting production delays or even inability to source material when needed. Forward contracts lock in supply but require capital commitment. Physical inventory builds provide security but tie up working capital. There's no perfect answer, but there is a framework. Treat silver as a critical input, not a commodity you can source on demand. Build relationships with reliable suppliers. Consider hedging strategies that protect against supply disruption, even if they cost more than spot market procurement. The additional cost is insurance against operational risk that could shut down production entirely. For family offices and high net worth individuals thinking about generational wealth preservation, the calculus shifts again. Time horizon extends beyond quarters or years into decades. The relevant question isn't what silver does next month. It's whether silver preserves purchasing power across economic cycles that include both growth and contraction, inflation and deflation, stability and chaos. Historical evidence spanning centuries suggests it does, not perfectly, not in straight lines, but over sufficient time periods. Tangible assets with inherent utility and limited supply tend to maintain relative value against fiat currency units that can be created without limit. This doesn't mean holding 100% in silver. It means holding enough that if monetary conditions deteriorate, if currency regimes change, if the current system transitions to something else, a meaningful portion of wealth remains protected. The timing question haunts every allocation decision. Dollar cost averaging provides one approach. Systematic purchases over extended periods smooth out entry points and remove emotion from execution. Opportunistic accumulation during periods of weakness provides another strategy. Wait for pullbacks. Deploy capital during stress. Build positions when others are fearful. Both methods have merit. Both require discipline. The trap to avoid is waiting for perfect clarity before acting. Perfect clarity never arrives. By the time everyone agrees silver is the right allocation, prices have already adjusted to reflect that consensus. Strategic positioning happens before consensus forms, not after. What about the scenario where this analysis is wrong, where silver prices decline substantially from here and remain depressed for years? This outcome is possible. Technological substitution could reduce industrial demand. Major new mining discoveries could flood supply. Central banks could execute flawless policy normalization that restores confidence in fiat currencies. If these things occur, silver holders experience opportunity cost. Capital deployed into silver generates lower returns than capital deployed elsewhere. This is the trade-off. But even in this scenario, silver doesn't go to zero. It retains industrial utility. It maintains monetary history spanning millennia. It remains finite in supply. The downside is bounded. The upside, given current monetary conditions and supply constraints, remains substantial. Here's what the evidence actually suggests when assembled without bias. Physical silver markets are demonstrating stress that paper markets aren't fully pricing. Industrial demand continues growing while mining supply struggles to keep pace. Monetary conditions globally remain extraordinarily accommodative, despite official rhetoric about normalization. Geopolitical fragmentation is accelerating, not reversing. And the participants who operate in physical markets with real capital exposure are accumulating, not distributing. They're not doing this because they're bullish. They're doing this because they're realistic about risks that conventional analysis dismisses or ignores. The strategic imperative isn't to predict what happens next. It's to position for a range of outcomes that includes scenarios where current pricing proves inadequate. It's to recognize that market structure matters as much as price levels. It is to understand that waiting for lower prices might mean watching availability disappear even as quoted prices look attractive. And it is to accept that in environments where monetary systems face pressure and commodity supply chains show fragility, the cost of being wrong about not holding tangible assets exceeds the cost of being wrong about holding them. The market isn't sending mixed signals. It's sending very clear signals to those willing to look beyond price charts. The disconnect between paper and physical, the premium expansion during price weakness, the institutional accumulation, the dealer behavior, all of it points in the same direction. What remains uncertain is timing. How long can paper markets maintain pricing that physical markets reject? How long before the gap forces reconciliation? These questions lack answers, but the strategic response doesn't require knowing when. It requires recognizing that the probability has shifted meaningfully and positioning accordingly while positioning remains possible at manageable cost. Because once the consensus shifts, once the broader market recognizes what physical market participants already understand, the opportunity to position strategically disappears. What remains is simply paying whatever price the market demands, assuming supply remains available at all. And the lesson from the past 2 weeks is clear. When stress arrives, when paper and physical diverge, the physical market doesn't become more liquid, it becomes less. And the window for strategic action closes faster than conventional analysis assumes possible. The choice ultimately comes down to risk preference and time horizon. But the data, the market behavior, the structural trends, They all suggest that treating current silver prices as expensive relative to recent history misses the more important point. Expensive relative to what? Paper markets showing stress, monetary systems under unprecedented pressure, supply chains demonstrating fragility, industrial demand reaching historic levels. When the measuring stick itself becomes unstable, when the market structure shows signs of breakdown, traditional valuation frameworks lose reliability. What matters is positioning that makes sense across multiple scenarios, that preserves optionality, that provides protection without requiring catastrophe to prove valuable. Silver offers this profile. Not perfectly, not without cost, but with characteristics that become increasingly relevant as the gap between financial market pricing and physical market reality continues widening. The question isn't whether you believe silver will outperform other assets. The question is whether you're prepared for the scenario where it becomes the only asset that performs the specific function your portfolio requires. And based on what we've witnessed recently, that scenario deserves more consideration than conventional wisdom typically allows.